Section 13, Real Estate Finance Calculations. Unit 1, Loan Qualifying Ratios and Calculations. Unit 2, Loan Payment Calculations. Unit 3, Calculating Value in Net. Loan Origination Fee. Lenders often receive compensation by charging loan origination fees. If you heard that ABC Bank charges a 1% loan origination fee, this would mean that ABC charged 1% of the loan up front, which is paid by the borrower at closing. Loan origination fees are especially common with mortgage brokers. They may vary between 1% and 3%. Loan fees higher than 3% no longer qualify as qualified mortgages, so very few lenders charge anything above 3%. Example, let's say that XYZ lender charges a 2% loan origination fee. Kelly and Bob are buying a home that costs $250,000, and they are obtaining a 90% loan and paying the loan origination fee. Their loan origination fee could be calculated like this. Loan-to-value ratios. Type of loan. Maximum loan-to-value ratio. Conventional. Possibly as high as 95%*, depends on loan value, type, and borrower credit score. Fannie Mae conforming. Ranges from 60% up to 97%, depends on loan, property, and transaction type and borrower credit score. Freddie Mac conforming. Ranges from 70% up to 95%. FHA insured. Up to 96.5%. VA guaranteed. Up to 100%. Asterisk mortgage insurance may be required for loans with LTVRs greater than 80%, except for VA loans, which do not require it and don't allow it to be charged. Debt ratios and qualifying income for borrowers. Lenders collect a lot of information about borrower income and debt on the loan application. They'll use this information to calculate the borrower's ability to repay the loan. The main calculations are debt-to-income and housing ratio. Debt-to-income. Debt-to-income ratio calculates total monthly debt payments, including anticipated housing expense, against gross monthly income. Typical items included in this calculation are utilities, auto loans, and credit card debt. Borrowers may also have payments on debt that doesn't occur monthly, such as student loans. Any debt with payments that will last longer than 10 months is included in the ratio. Other terms you may hear for this ratio are total debt ratio and back-end ratio. Calculating debt-to-income. The debt-to-income calculation divides the total monthly debt obligation by monthly gross income, and multiplies the result by 100 to obtain the debt percentage. For example, if total monthly debt obligation is $3,000 and total monthly income is $5,000, the debt-to-income ratio is $3,000 divided by $5,000 times 100, or 60%. Housing ratio. Housing ratio calculates total monthly housing payments against gross monthly income. The expenses included are home loan payment, principal, interest, property taxes, home insurance premiums, mortgage insurance premiums, homeowner or condo association fees, if applicable. Total housing expenses must not exceed 31% of total gross monthly income. Another term you may hear for this ratio is front-end ratio. Calculating housing ratio. The housing ratio calculation is principal plus interest plus taxes plus insurance plus association fees, divided by monthly gross income, times 100. For example, if a borrower's loan will result in a monthly payment of $1,200, including principal, interest, taxes, homeowner's insurance, and any association fees, and monthly gross income is $5,000, the calculation would be $1,200 divided by $5,000, times 100 equals 24%. Using the ratios. If you're working with clients who haven't yet selected a house, the housing and debt ratios can still be useful by helping them to determine the highest housing payment they could obtain. This doesn't mean they should shop at their limit, however. Here's how the buyer can calculate maximum housing payment using both housing and total debt ratios. Maximum housing payment equals allowed housing ratio percent divided by 100 times monthly gross income. Maximum housing payment equals allowed total debt ratio percent divided by 100 times monthly gross income, other debt. Let's look at an example. Example. John earns a gross monthly income of $5,000 and has $500 in monthly debt payments that aren't part of his housing calculation. He wants to qualify for a conventional loan, so he uses a housing ratio of 28% and a total debt ratio of 36%. He wants to know the maximum housing payment that he'd be making under those conditions, so he can determine the approximate amount of the loan for which he can qualify. Let's start with the housing ratio first. 28% divided by 100 times $5,000 equals 0.28 times $5,000 equals $1,400 housing payment. Next, we'll look at the total debt ratio. 36% divided by 100 times $5,000 to $500 equals 0.36 times $5,000 to $500 equals $1,300 housing payment. A buyer needs to meet both ratios, so John's maximum housing payment is $1,300. Obviously, houses aren't listed for sale based on their monthly payment, so a little more data will be needed, such as down payment amount, prevailing interest rate, taxes and insurance, type of loan, etc., to determine a shopping price range, but this is a good start, and the monthly payment is what most buyers will want to know. Housing and total debt ratios. Conventional loans. Total debt ratio, 36%. Housing ratio, 28%. Fannie Mae conforming loans. Total debt ratio, 36, 45% asterisk. Housing ratio, 28% asterisk. Freddie Mac conforming loans. Total debt ratio, up to 45% asterisk. Housing ratio, not applicable. FHA loans. Total debt ratio, 43%. Housing ratio, 31%. VA loans. Total debt ratio, 41%. Housing ratio, not applicable.